Good news for Hologram shareholders. The stock price is really undervalued. And let me tell you why. From this level, the stock price should go up 4x. But only if. There is a if here. So let me explain first. MicroCloud Hologram, right? You can see on Google Finance, according to Google Finance, market cap $148 million, right? You can see here. Then if you check on Yahoo Finance, MicroCloud, look at market cap, $17 million. Now, there is a difference, and you don't have to rely on those numbers. But at least we can agree that the stock price is around 86 cents on Yahoo Finance and Google Finance. Now, how do you find the real market cap of this company? Luckily, this company, MicroCloud Hologram, have submitted their files, where you can find the number of shares outstanding. So, if you go to their balance sheet, you can see here, December 31st, 2024, they submitted these filings a few days ago, and we can see the number of shares. Here, they have two classes of shares, and our class, for normal investors like us, is class A, ordinary shares. And here we can see the number of shares. Shares issued and outstanding as of December 31st, 2024. This means the second number here. So you can see 54.5 million shares outstanding. We take this number, copy, and let's do the math, right? So we have the number of shares and multiply it by the current stock price, 86 cents, right? So let's multiply by 86 cents. And here you have the real market cap of this company. So you can see that the market cap is about $46.8 million. So not 148 million, neither 17 million, but $46.8 million. And here is the best part. If you look at their balance sheet, their assets, you can see that more recently they increased their short-term investments. You can see here on the right side in US dollars. They reported from renminbi to US dollars. And you can see that they have cash and cash equivalents, $118 million, plus short-term investments of $100.9 million. Do the math. In total, they have $19 million, close to $220 million in cash and short-term investments. And you look at the market cap of only $46.8 million. From this level, you can see that the stock price is undervalued, below the cash on hand. So you can have from 46 million to over 200 million, 4x easily. So 4x from this investment. Now you might say that they also have some liabilities, but also let's look at their total liabilities. So total liabilities, $4.4 million. And as they have over close to $220 million, they are still left with $200 million in cash and short-term investments, which is much higher than the current market cap of $46 million. So what a great opportunity. Why don't more people choose to invest in hologram stock? And the stock price to 4x in just a few days. Why aren't they doing that? If you look at the stock price, year to date is down quite a lot, over 85%. But why people don't invest in this company? You've seen their balance sheet, over $200 million in dollars, and the market cap lower than $50 million. So a great bargain. But what's the catch with this company? First of all, big funds can't invest in this company Because if they buy, let's say $5 million, the stock price will skyrocket. The first thing. So only small investors can invest in this company because of their size. Less than 50 million in market cap. The first thing. The second thing you have to be aware is, yes, they have a lot of cash. You've seen the number of shares, but if you pay close attention to the number of shares, you see an increase from close to 300,000 to over 54 million shares outstanding. And this is a lot. Let me explain what does it mean, this increase in a number of shares. This is called dilution. Imagine you have 200 million in cash, right? As you can see here. And you have only, let's say, 1 million shareholders. Or let's say 300,000 shareholders. Only that, right? So if you want to divide your value among shareholders, you divide their cash by the number of shares. Close to 300,000. But if they add more shareholders, more owners to this company, then the value is divided by 54.5 million instead of 300,000. So automatically this value for every shareholder gets lower the more shares they issue. And this is the main risk with this company. You might say that they only have 54 million shares outstanding. In my past videos, you've seen that the number of shares were even higher than this. But be aware they also done some reverse stock splits. Here, you can see here, if you look at their notes, note 14, you can see the number of shares has increased over the years. And then, let me show you here, reverse stock split. You can see that they had one at the beginning of 2024 and one at the end. Reverse stock split, 1 for 10. And the second reverse stock split was approved on September 27th. Here. So that's why you see this difference in the number of shares compared to my past videos. But now we have the latest results, the latest filings. And that's the most important. We have to focus on the latest balance sheet. December 31st, 2024. Of course, they didn't submit the filings in December, but this month. They only report this for their past year, 2024. So, this is the number you have to look at. And as you can see, you see a huge increase in this number of shares. And if you wonder, where do they get this money? Over 100 million, over 200 million in total. Well, from issuing more shares to investors. And they raise money from the public market. They take that money to invest in their business and expand their operations, to increase their revenue, become profitable, and in the long term, shareholders may be rewarded, as long as this company becomes profitable. So that's the goal, the aim. Now, the problem that I see with this company is, if they continue to issue more shares, and you have this massive dilution, this is not 10x, 50x, this is even more than 100x. If you have, they continue to issue more shares and you have this massive dilution, the stock price will deliver a return like this, a decline over 85% year to date, in just a few months, from January to March. 3 months, a decline over 85%, this is quite bad. Now, if they stop issuing more shares, you might see an increase, but small increase, not that high. If they stop issuing more shares and they increase their revenue here, total operating revenues, you can see here, if they increase the revenue and reduce their losses, then you can expect the stock price to increase more in the future. But only if, as I said at the beginning, there is an if. If the revenue goes up and they become profitable, then you can see an increase in the stock price. And of course, they also have to stop issuing so many shares, Because if they continue as they did in the past, that will be really, really bad for current shareholders. You have to understand this risk. Now, let's assess. Can they increase the revenue more in the future? Let's look at their past numbers. You see in 2022 the revenue, in renminbi first, 487 million. Then in 2023, a decline, 23 million. And then in 2024, you can see a rebound in their revenue to 290 million renminbi. If you want in USD, for 2024, you can see 40 million in revenue. Now compare 40 million revenue with the current market cap, real market cap of 46 million. You can see that this business, the stock price is not that overvalued. Price to sales around 1. So it seems quite good as they operate in this high technology industry. Now, you also have to look at their segments. You can see here they have two segments, products and services. And you can see that their products over the last 3 years went quite down a lot, from 124 million to close to 8 million. And only their services, they had only a rebound in their services. And if you look at their loss from operations, yes, you see a huge decline in 2022, a decrease, but then that decline in their losses have increased, went back to 128 million. So this is not good. You have to see a decrease in their losses over the long term and an increase in their revenue. Now, to assess the future outlook of this business, you have to look at their products and services. What do they sell? You have to ask yourself, what do they sell? So let's check. Here, they are saying that they generate revenues primarily through sales of products related to holographic solution services, which include LiDAR and other holographic technology hardware products, licensing and content products and technology development service. So, their products are related to hardware products, which include LiDAR holographic technology, right? And services, the second segment, related to holographic technology services, which include holographic technology advertising, software development kit service, and promotion services. Now, ask yourself, if the services depend on holographic hardware products, then how will this business evolve over time? Will their services segment survive without their hardware products? That's a question you have to ask yourself, because their services are connected to their products, hardware products, holographic hardware products. And if this revenue goes to zero, what service will they sell? So this is a major warning, a question mark. From this level, I'm not sure if they can continue this growth rate in their services. Maybe if they can find other customers to see a rebound in their products, to gain some contracts, then that's a good sign. Their products rebound and their services can continue to grow more in the future. But if you see another decline in their products from 7 million to 0, then their services might decrease over time. So you have to be aware of this risk. So yes, they have on their balance sheet, as you've seen, over $200 million, but as you can see on their income statement, they earn 40 million revenue, but they spend more than that. They still have a loss of 19 million, and this is quite bad, especially if the revenue decreases over time and losses increases. That will be quite bad. So you have to be very, very careful with this company, because those losses of 19 million will be covered by, guess what? Their cash position. Imagine that this company is burning 20 million a year. In the next 5 to 10 years, they will burn all this money. So the value of this company will decrease over time if they don't become profitable. So right now, yes, it's undervalued based on their cash position. But if they continue to report more losses, those losses have to be covered by their cash position. So that's why you have to be very, very careful with this company. If you want to speculate, you think that this company is highly shorted, but I don't see the reason when this company has a lot of cash, why do you want to short it? Because they will survive for the next 5 years for sure, they will survive. As long as they don't do stupid things with that cash. I mean, to invest in other companies, and those companies to have only losses. And they won't do anything. So that's why you also have to look at the return they get for this cash. Yes, if they want to acquire another business, you also have to look if that business is profitable, because if they buy an unprofitable business with losses of about 20 million a year, then that will be another burning cash business. So you don't want that. For the moment, in a bank deposit, they earn an interest. You see here. Investment income. 5 million. So that's good. 5 million. 5 million. If they can reduce the losses to 5 million, only 5 million, they will cover those expenses and they will stop issuing more shares. That will be good. But again, this depends on the management. Their strategy, if they're able to turn this business around and increase the value for shareholders. If they can do that, don't have to worry about dilution or the stock price. In the long term, they will do great. So that's it for this video. And if you have other questions, please let me know in the comments.